Hi, everyone. Thanks so much for coming today for our home buying seminar. My name is Laura Ebenstein. I work with the Harvard Union of Clerical and Technical Workers, and we have been working with the Harvard University Employees Credit Union on a number of workshops to help people with different financial concerns or ideas or goals. And we're so excited about this partnership. Um, you can go to their website to see more of what we are working on together. But today we are here to talk about home buying, which a lot of us are striving for at this moment in time. So I'm going to pass this on to Dominique, who's going to introduce the subject with the credit union. Thanks so much.
Thank you so much, Laura. I really appreciate it. I appreciate everyone attending this wonderful webinar today. I wanted to remind you that we are reducing any of the background noises. So if your dog is barking in the background, it's okay. That we're going to mute all of that. And also wanted to remind you that we are using the chat feature, the question feature, to submit all of your questions. Actually, let's test it and see where you're joining us from. Let's see where some of you are joining us. You can put that in there. While you're doing that, I will continue to remind you that this presentation is being recorded. So in case you missed any portion of it, you want to replay it, if you have any questions, you can watch it on our YouTube channel at My HUECU on YouTube. And also at the end, we have a survey, so you can take part of it. And I will remind you again at the end, just to let us know how we did and how we can improve. Next slide, please. Wanted to talk to you about what's the difference between a credit union. So we offer a lot of better value. We exist solely for our members. We provide a bunch of different rates, savings, loans, checking account, and we really exist to provide that service. Anything that any benefit that we have, any money that we make, we put it back out into the community as well as back to our members. And I have some great news for a lot of our members who are in the LMA area. We have a new branch that will be opening this fall, and it's right down the street on Brookline Avenue and Longwood. So if you are feeling like a little left out, we have a new branch coming up, so you can do a lot of your banking there in person as well. And without further ado, today's presenter is Helen Lascaris. She is serving at the MGH branch, Assembly Row, and Navy Yard communities. And Helen is going to be our presenter today. Thank you so much for joining us, Helen.
Thank you, Dominique. Welcome, everyone. Today, our agenda is going to be to kind of walk you through what you would go through if you were going to buy a home or a condo, talk about, a little bit, an overview of mortgage qualification, and hopefully give you an idea of what your next step should be following this webinar. So let's get right into it. You have a lot of financing options when you're thinking about purchasing a home or a condo or a multifamily property. And what do we offer that is different from other lenders, such as mortgage companies or big banks? Well, one of the things that I think is most important that we offer is personalized service. So you'll be working with a loan officer from start to finish, from the time you start your pre-approval through the time you close. And that loan officer will be monitoring your progress as you progress through the mortgage process, and will also be available to you. We have our calendars open. You make an appointment anytime you don't understand something, you just want to check in more frequently or whatever. So we do offer that end-to-end high touch, which I think is really important, especially for a first-time home buyer. We have a range of mortgage products, including we offer the Fannie Mae Home Ready product, which is a 3% down payment, home loan that has some flexible guidelines, and you do have to qualify there are income restrictions to it. For example, I looked up Middlesex County. The income limit is $106,640 to participate in that program. We also give a discounted rate to our first-time home buyers. We give them 1/8 off our posted rates, which we post every day on our website. And we have competitive rates here at the credit union. We do have a quirk compared to other lenders. The rate you see on our website is the rate that's available that day. You do have to have an accepted offer to lock a rate, but whether you're putting 3% down or 50% down, whether you're buying a condo or a single family or a multifamily, that rate will apply to you, and regardless of your credit score, provided that you have a qualifying credit score. We have a fully digital process. We do have branch hours too. There are people that do like to come in, but honestly, I would say 90% of our members, we do Zoom calls with them and phone calls, but we don't meet in person, which we'd like to, but we haven't. So we have the capability of a complete digital process. Another important item is we do service the loans after closing. So we're looking to make a relationship with you. We aren't just looking to do this transaction. So we want you to call us, after the loan closes. If you have questions about automatic payments or whatever, we're going to be there to answer those questions, or what other questions, removing your PMI, which I'll talk about a little later. Another important thing we do is we have portfolio lending capability. What that means is, and especially with a lot of condo buying here, condos are a little more affordable than single families. And if you want to live in the city, most likely you're considering a condo. Most lenders, a lot of lenders, there's investors on one side and you and the borrower on the other side, and you have to meet the investor guidelines to be approved. On condos, sometimes we don't know those right away that condo is going to meet those guidelines. We have to do some investigating, request some information from the condo association, and if for some reason it doesn't meet the investor guidelines and you're with a mortgage company, your loan won't be able to go forward because they don't lend their own money. They lend other people's money. The credit union, we lend our own money. So we are able to keep that loan in our portfolio, even if it doesn't meet an investor's guidelines. So I think there's a lot of benefit to considering HUECU. We don't offer every mortgage product that's available. We have the bulk of what's available. Conventional financing is the most prevalent financing. But we know about other products out there. So if I'm talking to someone and I think they'd be better off with a product that I don't offer, I'm going to tell them that. I'm going to ask them, you should research this. So we're there really to help you and be a resource the whole way. So let's go to the next slide. So what is the current temperature in the real estate market? So as I'm sure you all know, because it's all over the news, interest rates have gone way up. So last year we were doing fixed rate loans at 3%. Today, that same loan is 5.875%. So it's a bucket of cold water thrown onto the mortgage market, because someone that could qualify for $500,000 last year, just because the rates have gone up, it's lowering the amount they can get a loan for. And guess what? The prices are not coming down. So it's making it more challenging, probably like you're experiencing with rent going up. It's a tough situation. I do feel last year there was fierce bidding on properties. There would be an open house would be crowded. There would be 10 to 20 offers on a property. A lot of people with lower down payments couldn't get accepted. Now it's cooled off. Some people have pulled out. Other people are holding off for other reasons. They're turned off by the interest rates, so they want to wait. So there's less competition. That's the silver lining here. So the market conditions, there are price reductions. Sellers are trying to get these top dollars. No one's biting, so they're reducing their prices. So I would say the temperature is warm overall, not cold, warm. If you're paying a high rent, I would say it's always a good time to consider buying. At least checking what could I get for the same rent I'm paying every month. So let's go on to the next slide. So where do you start? What do you do first? I mean, most people will start looking at properties on their phone and dreaming about, where they'd like to live. But really, even you might go to a realtor, but the realtor is likely going to tell you, go talk to a lender and find out what you qualify for. So let's go to the next slide. So you call the credit union or another lender, and you're going to do a pre-qualification or a pre-approval. Now, the difference is A pre-qualification, I think, would benefit everybody is a conversation. So we're going to ask you about your credit, your assets, how much you have for a down payment, your income, and we're going to look at the products we have that you would qualify for. But you're going to get your credit score from your credit card or whatever. It's not the same score we use. We use very specific models in the mortgage industry, but it's a good proxy. We're going to look at your income. You're going to tell us your salary. If you're self-employed, we want to see 2 years of self-employment income. If you have rental income, we want to see that. So we're going to be looking at your pay. We want to look at the stability of your income, how long you've been at your employer. We want to look at your assets, your bank statements, because in this mortgage process, large deposits are always scrutinized. So we want to know where they came from. You can get a gift from a blood relative, immediate family member towards the down payment. We're going to talk about PMI. So PMI is called private mortgage insurance. And, you know, probably if you talk to your parents and they'll say you have to have 20% down or you shouldn't buy a house. Well, in today's world, no one really has 20% down. Very few people do because the prices are high. You have high rents, you have student loan debt. So you really aren't able to save the kind of money on a short period of time to have 20% down. PMI is private mortgage insurance. It can be very affordable if you have good credit. And it's an additional monthly payment when you're putting less than 20% down. There's ways to remove it on our programs, which are conventional financing, which is the most widely used financing. The PMI payment can be removed after 2 years. You can remove it by requesting an appraisal, and if your property value supports, that the PMI be removed, which would mean that your loan to value is 78%, I believe is the rule, then that PMI comes off. The loan still stays the way it is. You don't have to refinance. You know, I had someone call me and she wanted to refinance, but she had an FHA loan at 3%, and her PMI payment was $319 a month. But because rates have gone up, she was stuck. She's going to stay with what she has and keep paying the PMI, even though her property has appreciated so much that she could remove it. And I said, I wish you came to us and did a home ready loan instead of PMI, which is or a 3% down loan conventional, because we have that option. So if you're looking at FHA, which is a program we don't have, but it's also a 3.5% down program, keep in mind that if you do put less than 10% down initially, that PMI is going to be on there for the life of the loan. You can always refinance, but on ours, there's more flexibility. We're going to talk to you about the products. We have what we call conforming and jumbo loans. I'm not really focusing on jumbos right now or multifamilies in this talk, but you could buy a $1 million home with 5% down and have PMI if you qualify. The conforming loan limits, these are limits set by the government-sponsored entities, Fannie Mae and Freddie Mac. They provide funding for loans, are changed every year. Right now, that loan limit is $647,200. Why is that important? Because that's the limit that you could do with a 3% down payment. You can't do an $800,000 loan with a 3% down payment. That's the limit. And they change the limit every year because prices have been appreciating, like crazy these past 5 years. That limit just keeps going up every year. And I've heard chatter that it's going to be over 700 next year. So you could probably buy a home with 3% down, a $700,000 home with, say, a $21,000 down payment. So the pre-qualification, we're going to have a conversation. We're going to discuss all these things. If there's 2 people involved, we're going to get all this information for 2 people. You're just going to gather it, and we're going to talk on the phone or on a Zoom call. We're not going to pull your credit. And then we're just going to say, well, it looks like this is your qualification amount. We're going to estimate taxes and a condo fee. If you're looking at a condo, we're going to say, where are you looking? And let's look at the tax rate in that town, and let's factor that in. And then you have some idea of where to start. The pre-approval process is a credit pull and a letter that's issued that's good for 90 days, and you can go and make an offer on a property with the letter. You do need a pre-approval letter to make an offer on a property. So that's the difference between a pre-qual or pre-approval. I like to, if someone's new and just not sure what they want to do, no need to pull credit at the outset. Let's pre-qualify you and see if what you qualify for makes any sense. Like I have someone that they want to live in Boston, but their income was low and they only qualified for like $200,000. There really wasn't anything that they liked. So then they had to think about, are they going to go further out? Are they going to wait and try and save more? So these are the, the calculations we do that lead us to these questions of how you're going to proceed. So the only way to find out is by make an appointment with one of us. We're happy to spend the time to give you a pre-qualification and a pre-approval if you find, oh, this is great. I'm very thrilled. This is exactly what I'm looking for. I want to start shopping for a home. And it happens. I mean, I've had people, they get a pre-approval and they hit a home run on the first offer gets accepted and they're like shocked. And it's great. So let's go on to the next screen. After we do the pre-qual, you may find out that you can afford a lot less than you thought, more than you thought. Depending on that, you may want to look at your expenses and save more, or really start planning for that process. And we do have a partner, GreenPath, that's a free resource for our members. They can do credit counseling, budget counseling. So it's always good to make a budget. Like Helen told me I can qualify for a $4,000 a month housing payment. And they don't forget anything in your budget, like grooming, your travel expenses, everything. They go through everything to really look at how much cash flow you have, what you're going to have, after you contemplate this housing payment, and also think about the future. If you're thinking of going back to school, if you're thinking of, starting a family, there might be daycare expenses. You kind of have to, when you're thinking of buying a house, plan out. And GreenPath is a really great resource. If you find your credit is not up to the level that you want, they can help you with that too. That's always a place to start, is credit too. So let's go on to the next slide. So you've gotten a pre-qualification idea. You know your own credit. If you want, we can pull credit. I just want to clarify, if you're really concerned about your credit, it's worth it to pull it, and let's review it. But the next step would be, you're going to think about contacting a realtor. And you can't just call a realtor and not know any idea what you want. You have to give them some idea. And these are the items that we found people really look at when they're kind of crafting what they want to buy in a home or a condo. Location, what do they want to be close to? Schools, public transportation, they want land, and we do finance in all of the New England states now. A lot of people have moved to Providence, or they've moved to Maine. They have a remote situation. So we finance in Maine, New Hampshire, Connecticut, Rhode Island, and Vermont now. So that's been, I think, since the past couple of years, we've expanded. So we're doing a lot of business in those states, and some of them are more affordable. What property type are you looking at? What features do you want? So you really, need to think about what you cannot negotiate on and what you can. And it's important that you do take the time to do this, because otherwise you're going to waste your time and a realtor's time showing you properties that you don't like, and it can be frustrating. So really thinking about these items is going to help you kind of narrow things down a little bit. So let's go to the next slide. So this slide, you found a place, now what? So let's say you're online, you're looking, and you see something. Oh my God, Helen pre-qualified me. I'm browsing on my phone. I found a great place. I think I want to do something. What do I do? So let's go to the next slide. So you do need to, let's go to the next slide. I recommend you need to assemble a team. So you've got your lender that you've already talked to for a pre-qualification. When you're looking at lenders, you're going to look at the product menu. What products do they offer? I told you we offer conventional. There's many other products out there. You want a loan officer that's available to you when you need them, especially as a first-time home buyer. And I can say we do probably 5 to 10 purchases a month with first-time home buyers. I mean, maybe, during the spring for sure. So we're very well versed in that. So you want to make sure, we talk to people at all times of the day, of the night. So you want to make sure that your loan officer is going to be there when you need them and not just disappear after they take an application. That's the service component of it. It's very important that you find the right realtor. That realtor is going to make a commission based on you would be signing a document saying this person's going to be my realtor for the next 3 months. If I buy a home in the next 3 months, they are going to get a commission. The commission is paid by the seller, by the way, so you would not be paying that commission. But if you just sign up with someone that you haven't vetted and you don't like them, you would have to get released from that 3-month agreement, or else you're really not going to get anyone else to work with you because they're not going to make a commission. And it's really important that you have a realtor that's community-based where you're looking. So if you're looking on the South Shore, you want a realtor on the South Shore. You want someone who's full-time and experienced. How do you find out if they're experienced? You ask them, last year, how many transactions did you represent buyers on, sellers on, what towns, what were the price ranges? And you find out, you ask them to do an analysis for you, and you determine whether you feel this person is experienced and knowledgeable in the area. Let's say you're open, South Shore, North Shore, I'm open as long as I'm on the commuter rail. Well, a lot of agents, an agent that's working, let's say, with you in Pembroke is not going to probably be going up to Gloucester to open houses. So a lot of agents have work for companies that have offices in different locations. So they probably know someone who's really good. If you like this agent on the South Shore, they probably know someone in one of their North Shore offices that can help you, that they can work together on your behalf and help you if your search is going to be that wide ranging. So, it's really important. A lot of people don't put enough effort into finding a realtor, and this thing called facilitation. So when you meet a realtor, let them take you out a little bit. You tell them those criteria you're interested in. You see how you work together. I've had people say, the realtor never calls me back. Well, this market is not as crazy as it was, but you still, the properties are not going under agreement the first weekend like they were last year, but you still want to get into a home that you want to see fairly quickly. So if a realtor is not returning your calls, that's a bad sign. So put some effort into that. So the team is going to be your lender, your realtor, and your attorney. Now, the attorney is going to come into the process after you have an accepted offer. You want a real estate attorney. You want someone who's accessible, and you want to know what their fee schedule is. We have attorneys. The credit union has attorneys we use a lot, and we get excellent feedback on, and we're happy to provide you with that list. Your realtor is also going to have attorneys. They might overlap, they might not, that they work with. So you're going to have good references to pick an attorney from. So I wouldn't worry too much about that. I would say one thing on that other screen, you found a house, now what? I would prefer if you got pre-qualified, found the realtor first, then find the house. So that way, you don't have the issue of maybe signing up with a realtor that you haven't really gotten to know. So I would, really focus on, identifying a realtor that you'd like to work with. So let's go on to the next slide. So I'm going to talk about Massachusetts, putting a property under agreement in Massachusetts, but in, say, Rhode Island and in New Hampshire, you just do a purchase and sale. There's no two-step process. Massachusetts is a two-step process. If you have family out of state and you try to tell them about, I got an accepted offer, I have this offer to purchase, they might not know what you're talking about. If you watch a lot of home shows, a lot of them are in California and they talk in different languages. They have a different process out there. But in Massachusetts, if you want to make an offer, the realtor is going to present it for you. It's like a 2-page sheet. You're going to give $1,000 as a good faith deposit. On the sheet, it's going to say, I'm going to offer $500,000. I'm going to put 3% down. I am going to get a mortgage of X amount by this date, and we're going to close on that date. I am going to do an inspection. This is all subject to me getting a mortgage, etc. And that's all going to be in the offer. You give your $1,000. The realtor presents the offer to the seller, and they have to be diligent in responding. So they can't just take your offer and sit on it and hope someone else comes along. They have to, there's a time frame. The realtor will say, I want a response within 24 hours. That's, I think, the typical. So everything is stated there. You're going to do an inspection. One thing I'm going to mention about contingencies, things got crazy in the past 2 years and people were waiving contingencies because they couldn't get offers accepted. That's really not anything I recommend at all. Don't waive the inspection. You know, you want to make sure that this property you're buying doesn't have any issues that were not disclosed to you that might cost money to fix, that you would have not offered that much had you known. Now, a lot of times, the inspection happens about 2 or 3 days after your offer is accepted. You're going to select an inspector. We always use Tiger in our home buying forum presentation that we do in the spring. But, you know, you can always do your own research and get any inspector that you choose. You're going to take a half day off from work. You're going to go with them to the property. Now, it's not an appraisal. They're not going to tell you, yeah, this property is worth what you paid for it. They're going to be looking to see the condition of the property. They're going to turn on the heat, turn on the air conditioning, open the windows, run the water, check the basement, check the roof. You know, they're looking at all these things that could cost you money if they were defective. And they're going to provide you with a report within 24 hours. And then you're either going to say, wow, and this has happened, this place needs a lot of work. I didn't expect that. I am going to back out. And you get your deposit back, and that's the end of it. Now, if you find some things that you didn't expect, but you can live with those, and I'll tell you, in New England, most of the houses are old, so there's always something. You might say, well, you know, I'd like to get a closing cost credit, or I'd like to reduce the price because I found A, B, and C. And then you can negotiate that. And whatever comes out of the inspection and is negotiated, if anything, goes into this second phase of the contract, which is called the purchase and sale agreement. That is the contract where you have to put up either the balance of your 3%, or if you're putting 20% down, they want 5% at purchase and sale. The mortgage contingency is going to carry over. It's going to say, this whole transaction is subject to me being approved for a mortgage by X date. It's carried over from the offer. Anything that resulted in the inspection, if they have to repair something, it's going to be in there that the seller is going to repair. Everything is outlined. If you're going to keep a swing set or a washer and dryer, that's all going to be in the purchase and sale. And it's a serious contract. So I've heard horror stories of people that waived their mortgage contingency, for whatever reason, got denied for the loan and lost their deposit. So I don't want to scare you, but I really don't recommend waiving it. And you don't have to now. The market's not hot, it's warm. Remember I said that. So, you know, contingencies are in there. All the purchases I see now have contingencies for the mortgage. They're doing inspections. I have an appraisal contingency says, I'm going to buy this house subject to it appraising for the purchase price. That used to be in there a lot in offers. I haven't seen it in the past several years because of the way the market is. The sellers don't have to have that. I haven't seen that come back lately. You can try to put that in so that if the appraisal comes in low, you can exit the transaction and get your money back. But most sellers are not accepting an appraisal contingency right now, but you can always try. So if the appraisal comes in low, which I haven't had any lately, if you're putting 3% down, basically the deal falls apart unless they are willing to reduce the price unless you have additional money to come in, because we will do 3% down on the appraised value, not the purchase price. If you're putting more money down, the transaction could still work if the appraisal came in low, depending. So you're going to have your purchase and sale. You're going to have your accepted offer. Let's go to the next slide. I know this is a lot of information. I don't expect you to remember it all. I hope nobody's frantically writing this down, because we will go through it with you step by step, and it's a lot easier to digest in small bites. I'm giving you big bites here. So you have an accepted offer. You may or may not have the P&S. You can apply for a mortgage with the accepted offer. The P&S will come shortly, but usually people do their inspection before they apply to make sure that, they are going to proceed with the transaction. You will get an official loan estimate, and we would give you a pre-application estimate before that when we were talking, when doing the pre-approval for you. And the loan estimate is going to have all the costs. It's going to have a bottom line. How much do you need to close this deal? How much do you need to show me in assets? And it's not just the down payment. There's more to it. You need down payment plus closing costs. Plus, we want to see that you have 2 to 6 months of payments left in reserve after closing. We can use retirement assets for reserve. No need to liquidate. Just want to know you have access to funds to make 2 payments in the event that you hit a snag of some kind and either lost a job or whatever. So at this point, you're not bound to apply for a mortgage where you got the pre-approval. I mean, we really would love to work with you, but if, say, you found a different program that you thought was going to be better for you, you could, at that point, change. I just want to make it clear that you're not, just because you did a pre-approval somewhere doesn't mean you can't do your financing elsewhere. And that happens a lot. Sometimes people do a pre-approval with a mortgage company, then they find out, wow, I'm eligible for the credit union. I'm going to go with the credit union. And one of our attorneys is part of the MetLife Legal. So if you're participating in that program, you will get a discount on the legal fees for a home purchase, which is a really nice discount. So you would check around for rates. You would submit your mortgage application, lock your rate in. Our rate locks are for 60 days. These transactions are typically happening in 45 days. You're going to get your loan estimate. It's official. These are the costs in the transaction. And then what will happen after you do that? After you make that decision, then you've got to go through the work, the processing of your mortgage. So let's go to the next slide. At that point, you're going to start providing documentation. You're going to provide your 2 most recent pay stubs, past 2 years W-2s, your bank statements, full, all pages. We'll be looking through for deposits, any large deposits. We want to know where they came from. Gifts are fine. So we'll be looking at that. We'll be also ordering an appraisal. Now, the appraisal, a lot of people call me, oh, no, I haven't been contacted for the appraisal. You're not going to be contacted for the appraisal. That's ordered by the credit union or your lender independently. They will contact the listing agent for access to the home, and they're going to go, or condo, and conduct an appraisal. It's different from the inspection. The appraiser is looking at the square footage, the kitchen, the bath, the condition of the property, and taking pictures, and then they're going to compare it to other properties that sold. That's how they value a property, using the comparison approach. So, and that's how your realtor is going to tell you also what they think you should offer. Based on this sold last month, it's very similar. So that's why it will support this purchase price. So the appraiser is doing their independent appraisal, and they're going to provide that back to us. We're going to be getting all your documentation, your income and asset documentation, put it together with the appraisal, and one of our underwriters. If it's a condo, there's a condo questionnaire. There's another layer of documentation. A condo questionnaire, we want to look at the insurance on the condo. We want to look at the budget. We want to, depending on how many units, and we're going to put all that together, and an underwriter is going to review it, and they're going to issue a commitment letter. Now, we issue commitment letters prior to the date that's in the contract that says you have to tell them you got a mortgage by that date. So we're very mindful because you don't want to let that date pass if you don't have the mortgage commitment, because then you put your deposit at risk. So we're really aware of that. Sometimes we ask for an extension for various reasons. The condo questionnaire, the condo association dragged their feet. We don't have it yet. We need to extend for a few days. That happens. So your attorney will send the seller's attorney. We are requesting to extend that mortgage date for 2 days. If you don't agree to that, then give us back our deposit. And they'll agree to it if it's a condo questionnaire issue. It's not a qualification issue. It's just a processing issue. And then when your loan is approved, it will be cleared to close. So that means that's telling your attorney and our closing team, you're good to go. You've met all the conditions of this loan. Start preparing the final figures. Now, one thing I want you not to do, and that people do, and that's why I have this on the right side with the X's, so I want you to remember this. Don't run to Jordan's Furniture a week before you close and order all this furniture, because we pull credit 24 to 48 hours prior to the closing, and we don't want to see that you've increased your debts since the application. Now, we will see if you've had a credit inquiry. If you went to Jordan's and they give these discounts if you finance it and things like that, it's so enticing. And I know, who wants to buy an empty home and have to wait a week to get the furniture? I know it's a pain, but we really don't want you getting any new credit until you've actually closed. So don't go to Jordan's. We'll see if you do, and people forget, and they do. We'll say we need the statement. We've got to incorporate the payment. It's got to go back to the underwriter. You don't want that. We don't want to see you escalating debts while you're in the process. Don't go buy a new car. Of course, there's situations that happen. Your car breaks down. You need it to get to work. The communication is key. You need to let us know. If you want to go to Jordan's, let us know. I have to do this. I can't wait. This is what I'm thinking of buying. This is the monthly payment, and we can try and incorporate it in. I can say, don't do it, or okay, it looks okay. I'll let the underwriter know in advance. We don't like to find out these surprises like at the last minute, because it can cause a lot of stress for everyone. I had someone recently who had a sick pet, and, the pet needed major medical care, and she charged it. It was like $5,000. And she told us right away. So we right away refactored everything. I mean, we understand that things do happen and that sometimes you have to do something. But the key is, if you do, you need to communicate it with us, especially if, you could have a debt ratio that's close to the max. Like, we don't like to go over 43% of your gross income for all your debt. That's the monthly payments on your credit report plus a new housing payment. So if you take on a new car payment or you've increased your credit card balances significantly, it could push you over. So that's why we really, people forget about this, and that's why I want to really reinforce it. So your loan is clear to close. The final figures are being prepared for you. So let's go to the next slide. So you're going to receive the final figures. And this is like a companion to the loan estimate. We're not allowed to, give you final figures that are totally different from your loan estimate. When we give you a loan estimate, we really can't increase fees. One thing that could increase, for example, if we find out, the taxes that they quoted were with a residential exemption, but you don't get that right away, the tax figure could increase. That's not a fee. That's another cost. So you can rest assured that you're not going to be shocked by what you see on the closing disclosure. You're going to be very familiar with it from your loan estimate of what you're expected to bring to closing. So you're going to get those final figures. You're going to have to acknowledge that no later than 4 days prior to your closing. And those figures are going to have directions on how to provide any funds due from you at closing. One thing people don't realize, and I wouldn't either if I didn't work in this field, the attorney's office is going to hold all the funds. So you don't have to give the money to the credit union, aggregate it into one account, I mean, you're going to wire the funds to the closing attorney, or some attorneys want you to make a check out to yourself. So that's how that works. You don't pay the closing costs separately. You pay it all at the end in one lump sum to the attorney. The attorney divvies it up, pays off the seller's mortgage, pays the appraiser, pays all the different fees. Another thing you're going to do is the day before closing or morning of, you're going to do a walkthrough. So usually people want the property empty. Broom swept condition is how they say it. So you're going to walk it through the property, make sure that everything's in order. If the washer and dryer was going to stay, you want to make sure it's still there. You want to make sure that I've had people that they've damaged a screen door while they were moving. So, that involved a little credit at the end, between the seller and the buyer, something small, but you want to make sure that they haven't left stuff in the property, that it's the way you expect it to be, the way it's stated it should be in the purchase and sale. If it's not, then we don't close. We have to rectify whatever it is. If there's repairs that needed to be done, we need to know that those have been done. So you're going to do the walkthrough, and then you're going to go to the closing, and you're going to get the keys to your home or a condo, and you're a homeowner. So let's go to the next slide. So just want to summarize. So you can get an express pre-approval from us. We have a spot on our website where you can fill in some information to notify us that you're interested in getting an express pre-approval. What's your most convenient location? We'll reach out to you and do that with you. You can call us or make an appointment with us to do the pre-qualification. If you're really not sure you want your credit pulled, you're going to get the pre-approval. You're going to vet out your realtor, make offers. Then when you finally get an accepted offer, you're going to, check lenders. You're going to submit a loan application, lock in your rate, get a loan estimate, and look at fees. There's two rates you're going to see on everything, the rate and the APR. Now, the APR is the rate including all the fees. So if you really don't want, you really want to do a quick and dirty of what's the best deal, look at the rate versus the APR. The closer the APR is to the rate on fixed rate products, then, the better deal it is. But I have to mention, and I didn't mention this and I wanted to, we also offer adjustable rate mortgages. A lot of people, I mention it and they say, I don't want it. I don't want to hear about it. Well, we're doing a lot of adjustable rate mortgages now because the rates are much lower. For example, today I have a 15-1 ARM offered for 4.875, but a 30-year fix is 5.875. So you could qualify for a much higher loan with a 15-1 ARM than you could with a 30-year fix. It's something that I do tell people when they call me. I explain the product to them. I send them information. ARMs have exploded because of the fixed rates gone up so high, and it's hurt people's affordabilities. So, I would be happy to talk with someone about those options. So you're going to get your loan estimate. The disclosures are going to be issued. You might look at ARM products as compared to fixed products and think about how long am I going to stay in this property? Do I think rates are going to go down? You can always refinance any loan. You're not married to the loan. Then you're going to submit all your documents for processing, and then we'll go to the next slide. And then we're going to do the credit review. We're going to get the appraisal, issue your commitment, give the closing instructions to the attorney. We're going to do that step. We're going to pull your credit, and we're also going to verify your employment. It's another step we do. And you're going to have your CD with the final figures and know where you provide those funds. And let's go to the next. And that's it. Then you get the keys and you're a homeowner. So, on our website, and I think we've updated it since this, but if you go to our website under products and services, go under home loans, there's a tab for first-time home buyers. There's tabs explaining adjustables. There's tabs for different things of submitting a pre-approval or a pre-qual. If you want a pre-qual, I would make an appointment for that. I hope that I haven't discouraged anyone. You're not too overwhelmed. Small bites, step by step. you can all become homeowners if you choose to. I know the rents are brutal in the area, and sometimes it seems futile, but I recommend, getting all the information and education that you can, and always being open to this opportunity, because in the long term, I really believe that it's better than renting. I mean, if you move around a lot, it might not be, but if you're looking to make roots, I think becoming a homeowner has a tremendous amount of benefits in many ways. So let's go to the next slide. I think, these are my colleagues. So I'm Helen. I'm based, I'm at the Mass General office 2 days a week in Cambridge. In Boston. Mike, Sharon, and Daisy are at the Harvard Square office, and Ryan is with me at the Mass General office. Now, Daisy really is based out of the Longwood medical area, so she'll be moving to that new office for any of you that find that convenient. And we all, really enjoy working with members, and happy to answer any questions you may have.
Thank you so much, Dave. I'm so happy that you gave a lot of our members some really good tips. Just wanted to remind everyone that this is being recorded, so you can also watch it on our YouTube channel. We have about 15 minutes left. I wanted to ask a few questions on the question. One person says, if a couple is applying, do you average the credit scores for qualification, or do both people need to be above a certain threshold?
Well, that's a good question. At times, they are averaged. We run them through an automated underwriting system, and they typically will average the scores if there's two people. But if you need PMI, it's tricky. You might not qualify if the lower person's score is really bad. It depends. So, I would recommend, contact me if you're interested, and I can kind of run through it. We do need 620 minimum, for PMI.
Okay, we have another question. Do home sellers ever decide which offer to choose based on the buyer?
Ooh, well, they really, I don't know, they don't know anything about the buyer other than what's on the offer. So they're really, and realtors used to put these love letters with the offers, but those are now, not allowed because, there could be discrimination or whatever. So it's really, they're just looking at someone with a cash offer is going to get the deal probably more than someone with 3% down, depending on the array of offers. So they're looking for, I want to close quickly. So that if they, they'll let you know what the demands might be. Closing quickly, wanting, a higher down payment. I think you could put a letter in, but it really would have to be a generic type letter, because a realtor would not submit a letter with your offer that had characteristics that shouldn't be in there. So maybe that you really love the house, and you can picture yourself cooking there or something like that would be okay. So they really don't really know the buyers. They really are just looking at the offer. They see a pre-approval letter and they see an offer, and they're looking at whether you can meet their whatever their priority is. Some people don't want to close till school ends, so they might be looking to close in 4 months. Some people, some buyers won't do that. So they're really looking to meet the criteria to get the highest price with the safest loan that they think is going to go through.
All right, we have time for about a few more questions. Does the inspector tell you the cost to fix the thing that may be old,
No.
or do they just tell you that it's old?
No, everyone wants them to, but they won't. They're not allowed to. They'll tell you to contact a licensed plumber, contact a licensed electrician. They'll just identify, this furnace looks old, like it needs to be replaced. I tell people, if you happen to have a handy family member, bring them with you on the inspection. Some people bring contractors to the inspection. So maybe, if you have that option, you can have someone that can give you those kinds of, prices, but the inspector won't. Sometimes, people, I have people that they intend to put 20% down, they find a great house, and the house needs a lot of work. And so, we can only lend based on what the house is worth right now. We don't have, an option where you can include work you're going to do in the future. I know the FHA program does have an option where you can get a higher loan amount than the purchase price and do some work. But for us, I would say maybe you should put 10% down and conserve the other 10% for your renovation, or things like that.
Okay, our last question. My boyfriend and I are pre-approved currently through the Harvard Credit Union. Since it expires after 90 days, we want to keep up with it, but not sure if it is necessary every 90 days. Do you agree, or do you get dinged every time your credit score is renewed for pre-approval?
Well, it is a hard credit pull. So if your credit is expiring in 90 days, if your pre-approval is expiring because your credit report is expiring, and you could pause. It doesn't have to be. We don't automatically pull your credit again in 90 days. I would recommend that person. If you don't think there's any changes to credit, then you're probably good there. You're going to just assume you're going to qualify for what you qualified for. I would check just to make sure the rates haven't risen that much that could impact you. But you could pause because it is a hard credit pull. If there's really nothing out there, you don't have to renew it every 90 days. You could wait a month. Some people take the winter off. There's less on the market in the winter, but it's less competitive too. So the credit pull will have a different impact on your credit depending on how your credit is. If you only have a couple credit cards that you've had, or you have a credit history for only a year or two, we're looking for 2 years, it would impact you a lot more than someone that has had a few car loans, installment loans, student loans. Someone with a deeper credit history, that inquiry is not going to impact them as much, provided they aren't like getting credit cards. It's a lot of inquiries that will impact your credit score. So I don't think the inquiry for a pre-approval would impact your credit score. But keep in mind that, let's say I pre-approve you, and in a month you find a house. I can use the credit report from the pre-approval I did, provided that you're closing within a certain time frame. So if there's really nothing you like, contact your loan officer. We usually can update it within 24 hours. So maybe it's not necessary for you to renew it after 90 days. You could just wait until you find a reason to renew it, that you see a property that you want to go for, and then renew it. That's what I would say.
All right, thank you. We have about 7 minutes left. We can squeeze in a few more questions. One is, can the credit union help with assuming a parent's mortgage in Maine?
We don't do assumptions. I don't know what that person means exactly. I mean, we would have to do it as a refinance. We could, take over the loan, but it would have to be a refinance with the current interest rate. We couldn't just assume a mortgage. We don't assume mortgages from other lenders. So probably that would have to be a refi, but we can do it. We do refinances in Maine. We certainly do. The parents are eligible too. Your parents are eligible to be members of the credit union as a family member. So they could refinance. Your brothers, your sisters, could also refinance with us. Or you could buy the house from your parents if that's what you're thinking of too.
Okay, we have one. Can you provide any advice or perspective on the conventional 97 loan as an option for first-time buyers?
I think it's a great option. The home ready, if you meet those income limits, you're going to have some flexibilities. The debt ratio can go up to 50%. The PMI will be lower. But, it's tough because if you're looking in Cambridge and your income is under those limits, how much are you going to qualify for? It's challenging. The only thing, I think that's an excellent program. I like it as compared to FHA on a single or a condo because the PMI is removable. Now, right now, you might say, well, I'm probably going to refinance if rates go down, so I'm not that worried about, I have a great rate, I want to keep it, if you, as a selling point of that versus FHA. The challenge is getting an accepted offer with a lower down payment. And now it is tipping in the favor of being able to do that. The past 2 years, I've had people that are so frustrated just because of all the cash offers and overbidding, et cetera, that they just got shut out. But I think, it's getting to the point where those offers are starting to be accepted, which is awesome. So I think it's a really great program, and I recommend it. I mean, Fannie Mae and Freddie Mac, their purpose is to promote home ownership. I mean, they're really concerned about the generations coming up being loaded with student debt, rents are going up. How are you going to get ahead? So they recognize that you need a little more help. So the 3% down program, the PMI payment is going to be lower. You can also use, if you live with someone and they're your boarder, so to speak, if you qualify for the Home Ready, they can, if they pay you rent every month, we can include that boarder income as part of your income if they're going to come with you to the new place. But I think you do have to show that they've been Venmoing you or whatever. We normally, that boarder income's not allowed. So they're making some, exceptions there and some other ones too that are nice. So we could discuss that program with you.
All right, we have about 4 minutes left. We can squeeze in this question. My grandparents may move here, and my husband and I want to pool our money to buy a house together. How does it work to buy a house jointly with another party?
We can do that. That sounds great. There's a lot of generational living, that's going on now. We have a lot of people doing that. So you would all be on the loan. You could all be on the loan. You could all be on the title, or you all might not be on the title. So you could have 4 owners, 4 borrowers, 2 owners, 3 borrowers. You could do it a lot of different ways. You'd have to look at everybody's credit, everybody's income, but we can have 4 borrowers. We also can have non-occupant co-borrowers. I didn't, mention that. There's so many things that we could talk about. So you could buy, I have a lot of people that, let's say you're a PhD student at Harvard, you have a stipend, you're going to be here for 6 years. You'd rather buy a condo than rent for 6 years, but obviously the salary you make, maybe $40,000, cannot support it. Well, your parent can come on the loan with you. If the parent's income can support it, they can be a non-occupant co-borrower. So there's a lot of different ways that we could look at it. But definitely you could buy a home with your grandparents, for sure.
Okay, this is our last question. I plan to buy a house with my husband. Is there any salary average that is required?
No, I mean, we don't average salaries. We're looking at your gross salary and your husband's gross salary. And that's how we're going to, craft the amount that you're approved for. We're not going to average the salaries. If one person is self-employed, we're going to be looking for 2 years of their self-employment, and we're going to, depending on their income, their net income, if it's rising or if it's consistent or inconsistent, how we're going to treat that income. We're going to probably average it. If it's going down, we're going to use the lower, because we're relying on that income to make your mortgage payment. We've never had a foreclosure here, so we're really looking for your best interest. Sometimes we might tell you something that isn't what you want to hear, but we're in here for the long term, the long view. We want you to be successful in purchasing your home, but we're definitely not going to average the income. We're going to look at both incomes. If, let's say you have 2 people, your husband's self-employed, his income is a loss or whatever, you might not want to, include his income. Well, you might want to do it based on just your income, which is fine. He can still be an owner of the home. He can still be on the loan. We also, I didn't mention one other thing. If you have no credit, if you're new here, we can develop a non-traditional credit profile for you. So there's options there too. If you don't have a lot of credit, you'd have to provide rental history, a cell phone bill. We have other options, because we realize that people are coming at this from a lot of different angles.
Thank you so much. Wanting to remind everyone that this presentation is being recorded on our YouTube channels. Or anything that Ellen may have said that you missed, you can catch it on My HUCU. And also to let you know that, our presentation is for educational purposes. Definitely contact your financial advisor and figure out what works best for you and your financial needs. And also keep in touch with us. Follow us on social media at HUECU, My HUECU. Thank you so much for joining us today. We hope that this information will help you in your home buying journey, and also join us on our next webinar. Thank you so much, everyone, behind the scenes as well as all of our attendees. Have a great afternoon.